Now, in our last segment, we're going to look at what is happening abroad. And we've seen some differentials come down a bit. As we were saying, we thought Saudi Aramco was going to lower the differential on one of their flagships, which is the Arab Light, into Asia. They reduced it by 40 cents, as we discussed last week, and they brought it down even further when you look at it from the perspective of the heavy side, coming into the U.S. and the Mediterranean and Europe and into to Europe, the Mediterranean, and the U.S. You can see that they actually kept prices the flat or higher. So again, you're still seeing some of these movements, but with that reduction, you're still seeing, as we talked about in segment 1, a fairly steady amount of purchasing. The hope is for them that they increase some of that buying in general. And you can see that they've started to see some of that product come out of floating storage. You can see that it's still very much elevated versus where it has been between 2017 and 2020. Still below where it was in 2016 following the price war, but you can see that it's still at a very high level. The goal is for them to bring this down further. Libya has cut their OSP. We'll see other people follow suit against the Saudi Arabian reduction, which should bring things down a bit on the differential side. Now, when you look at some of the spreads between where Brent is and where Middle Eastern crude, or when you look at it from the Dubai side, there's still a fairly sizable spread. It's close to about $8.60. So because of that, you're starting to see some of the opportunity come through, because when you compare it on where they reduced OSPs, it's becoming a bit more advantage to bring some of this crude from the Middle East into Asia versus going into other regions like West Africa, which price off of dated Brent, as well as into, obviously, directly from Europe itself. But we are still seeing a lot of U.S. crude moving into the market, both into Europe, but also Asia. Asia has still been a big buyer, and that's something that we really want to hone in on, because U.S. crude deliveries to Asia set to touch a record in November, and it's because of these spreads. Brent right now, 93.09, WTI at 86.35. LLS sitting at $90.04. So you're still seeing it being very competitive against the global market. And that's something that we think is going to persist when you look at flows. So as Europe continues to buy, Asia's buying, which again is going to keep us elevated on an export side at about that 3.8 million barrel a day number. It'll waffle up and down, but again, when we look at the average, there's a lot of staying power there. So then when you start looking at the differential side, well, West Africa is not going to sit still. They're going to try to find the price. So you're starting to see differentials come down. And again, it's because Brent has come up, dated Brent has come up. You've seen OSPs get set lower. You're seeing the spread open up a bit. So they're trying to compete to bring some of those cargoes through. The problem is, as we talked about in segment 1, there is a distillate shortage. Middle Eastern crude has a higher distillate cut, which again is going to incentivize people maintaining purchases or increasing purchases from the Middle East to try to capture that key piece of the crack spread, because realistically, the distillate crack is the only thing carrying refiners right now. Asia is at a record amount of gasoline in storage. Europe is at a record amount of gasoline in storage. Fujairah is at a very elevated level of gasoline in storage. So again, it's the diesel side, the distillate side, that is maintaining the crack spread. If that weakens, gasoline's is already moving negative. So if that weakens, the question is going to be, where are crack spreads? So, distillate is the one that is really carrying and maintaining the show. When you look at flows, the 4-week rolling average has us at about 4.178, just given where we are. So last week, exports were indicated at 3.92 million. This week, they came in at 3.5. So again, just moving further down to that average that we've been highlighting is likely the number of that 3.8 million barrels a day. So now when we look at where the spreads are between Dubai and Brent, this is where you can see it's right there at that 860, 875. And as we were saying last week, we see a lot of staying power here. We don't see a huge drop, but the reason why you're going to see staying power is because there's so much of that floating storage in the Middle East that they're trying to clear out. So they have to get a bit more competitive, which again is pushing this out, making Brent more expensive, creating a discount in Dubai, which is a net positive when you think about refining in Asia, just because they need the distillate cargoes. But then it is therefore showing up in West Africa, where Angolan and Nigerian sales have slowed considerably because they're trying to pick up, and countries would prefer to buy Middle Eastern crudes versus West African crudes, which is why we expect them to get more aggressive on the differential front. Crude oil on the water still remains right at the all-time highs for this time of year, and at the higher level for 2021. And the reason why is because when you look at crude oil in transit is moving back up. And that's when you look at crude oil in transit, we're seeing more cargoes leave floating storage and go into motion. So as crude oil in transit is coming up, we're seeing floating storage coming back down. So then here you can see that there was a drop in floating storage. We're now below the 2016 levels. But as we were saying, there's going to be a lot of lumpiness. So as this goes into motion, we see some of this showing up and then creating some of these problems where you're just going to have crude sitting offshore, which is why we think it's going to be fairly lumpy and move closer to where we were on the 2021 level. Asian floating storage fairly flat, as a lot of these cargoes are heading that way. So as they show up, that's when, again, we're going to see those cargoes go back into floating storage. But when you look at the comps versus 2020 versus 2021, they get much easier into the back end of November. So even if we only get a steady increase, you see that there's going to be the comps, and that's why we think that we're going to be very close to where we were in 2021. And here's your example. So China supertanker crude imports continuing to remain elevated, coming back down, but still on the higher side as guys cleaned up their import quotas. You're buying now, making sure that you have those cargoes showing up as we go into year end, but also setting it up into next year. So then when you start looking at underlying flows in general, Shandong Independent Refinery utilization rate continues to be fairly stable. But then China's crude demand for January to September was 2.8% lower year over year. Weaker demand has caused a periodic surplus, leading to a high level of gasoline and diesel inventory at various companies. CNPC achieved so-called 100 million ton goals at the end of 2019, which was originally targeted by 2025. 100 million tons of domestic oil production, 100 million tons of oil equivalent of gas output, 100 million tons of overseas equity oil and gas output. So again, they're trying to and as we've said, made in China 2025, trying to make sure that they can get their own raw materials to fill this gap. So there's still a lot of that coming through, and there's still going to be imports. The question is always going to be how big are those imports? And we see that spike, and as we've been saying, we see that slowing down. But as those boats show up, that's where we see that excess being held off on the offshore. And as we were saying, as you see that drop in Middle Eastern floating storage, you're seeing an increase in West African floating storage. And that's because you're seeing some of these deferrals and the slowdown in underlying sales going into West Africa. The other problem is you have Kazakhstan in the with the export production at 8-month highs and going higher as they ramp back up, and that crude comes from CPC. Libya continues to be fairly stable in their flows, and that's, again, feeding into a lot of the European demand, which is still, again, trying to find Urals. So you'll still see some of these flows, but with Asia coming down, that's where you're going to see West African floating storage continue to move higher. When you look at the U.S. in general, you had a big spike in exports of gasoline of 1.55 million barrels a day. Distillate, nice big bump of 525,000 barrels a day. And a lot of that distillate was going to Europe. And some of Europe was actually coming into Pad 1. So when you're actually seeing this flip, because we have the inability just based on cost and the Jones Act to go from Houston to New York Harbor, so it even makes sense to close an ARB between Pad 3 and Europe, and then close an ARB between Europe and Pad 1, which is funny in its own right on the distillate front. But again, this is the world we live in. Propane, propylene, small drop, but again, still well above the 5-year average. And then crude oil exports coming down. But a lot of that is also timing, because distillate exports, gasoline exports, and then you have a drop in crude exports. So then you'll see some of that flip. And then it's just going to be a matter of where are we on that rolling average. And here you can see that gasoline exports coming back to the highs, and we see that just maintaining above the 5-year average. We thought it was going to come down to the 5-year and hold there. Instead, it's definitely holding up and will remain something closer to the elevated point. Here was that nice little bump. We expect this to hold closer to the 5-year, but now trending back towards the upper level, just because the gas oil and the distillate side in Europe continues to get worse as well. So it's going to make a lot of sense to go from the U.S. into the European markets. Ethane, again, fairly stable. It's going to stay at the high end, but just because we have the beholden factor going into China. Ethane rejections is increasing, so we will have more ethane supply available, but there still remains that export market, but we do see some pressure coming into pricing. And then when you look at crude oil exports, again, at the higher end, and then when you look at propane, propylene, still staying at the upper end, and we don't really see that changing. When we look at what's happening in Fujairah, there was a big increase in builds. Builds rose by 3.21 million, so this is the first week that they have breached the 25 million barrel level, and the highest levels they have been since late August 2020. Total stocks were last higher when they stood at 26.68 million on August 24th, 2020. The stock movement saw builds across all three categories, with heavy resid posting the largest. And this is what we were saying last week, where as Diwali ramps down, you had some of that residual that is now gone. We expected to see sizable builds in light distillate and heavy disty, and that's exactly what we got. Now, when we look at the light distillate side, they rose 897,000 barrels to 7.25 million. The East of Suez gasoline complex softened because you had the Chinese exports, which are bolstering overall gasoline supplies and putting some of that downward pressure, which is pushing back and keeping more gasoline in Fujairah. Middle distillate rose 620,000 barrels. East of Suez gas oil complex was fairly range bound, but the West Suez continues to have optionality. So this was a good quote, I thought. Swing gas oil barrels offered in tenders loading from the Arab Gulf and west coast of India could easily be pulled west amid still viable arbitrage economics coming into the Atlantic Basin. Again, that is still going to be the case, and this number is going to stay at the very low end because there's still a lot of demand and reason to push this into the Atlantic region. Heavy resid rose 1.693 million. That's the highest level since May of 2021. And when you look at just as we've been saying, lower pricing, lower trade, more product getting stuck there. And that's why we're expecting the middle distillate to lose ground going into Central Asia and more heavy disty to replace it on the power burn side. The Brent time spread came down. Again, it's just, as we've been saying, it's going to be fairly range bound. We think that there's some staying power here. We don't see a huge shift at this point in time, just because given the prices have come down today. But there's going to be a lot of volatility. But we don't see this coming back to $1. It's something that's going to find that floor closer to $1.30 and likely stay between the $1.30, $1.35. And here, when you start looking at some of the flows and why we're getting some of that pressure, you have additional CPC, additional Libya, additional discounts coming from West Africa. So that'll help pull down some of those time spreads. But again, there's still a lot of crude demand that has been lost with the Russian barrels. You can see Nigeria had an increase of expected exports in November, and then a bigger increase from 1.07 to 1.23 million in December. November Nigerian barrels are still yet to find buyers, holding back the country's December sales. In total, up to 10 cargoes of Nigerian crude for loading this month are yet to find buyers. So that's the biggest concern, because it's hard to solidify what December is going to look like if you're going to have deferrals because you can't sell the November cargoes. Increased competition from Missouri and Libyan barrels into Europe, as well as expensive freight costs, are curbing Nigerian sales, which is why those differentials are coming down, because of those underlying issues that are going to persist. Some December Nigerian barrels are moving, but trades so far are limited. Then when you look at Angola sales have also had a quieter week, with the country still looking to sell 15 out of 36 December cargoes. And then again, when you look at Nigeria's Forcados, was dropped from $8 to $7.55. Vital has been dropping. Again, you're just seeing a lot of these different pieces go lower, because they're trying to incentivize buying, given some of these disconnects. Genscape crude, European crude, moved up. We're closer to where we were in 2015 and 2020. And just given the issues on refining in Europe, we just expect this crude to remain on the higher side. When you look at gas oil in total, you can see that we're going back to 2007. This is the second lowest we've ever been. There was a small draw of 21,000 tons. And again, we expect things to be fairly stable in terms of where they are and where demand is. And as things get colder, we do expect that to again drop down. Gasoline, as we said, has fallen a bit, but is still seasonally adjusted, the highest it's ever been in comparison to 2020. And just given the problem on the arbitrage from Europe to the U.S., that is going to remain a massive overhang. As fuel oil has a nice spike, which as this goes up, and prices should come down, but it's all going to come down to freight, because some of this can easily go into the Asian markets. The question is it going to price itself low enough to incentivize that movement? When you look at Singapore, on the total side, we had a drop of 3 million, just under 3 million barrels, still at the higher end. But realistically, the biggest drop was from the resid side, which we do think is going to reverse. When you look at light distillate, highest it's ever been by a very large margin. We don't see that changing, especially with that gasoline from China coming in. Some of that is going to push back and leave more in storage. Then when you look at what is happening on the middle distillate side, lowest it's ever been, going back to 2002. That is, again, making it very expensive for countries there to buy, sending some of it additional west. And that, again, is going to incentivize more people to purchase resid and heavy fuel oil, or heavy disti. But you can see we're still above that average, and we're just going to bump along these levels, because even as we have an increased power burn using this crude, you're going to have a decrease of the demand for middle distillate, and they're going to come down to this level. When you look at North Sea floating storage, still remaining at the higher end for 2022, given the pricing dynamics, that's going to stay the case. As prices come down, you should start to see some of this move. And then when you look at Europe, as we were saying, timing delay, floating storage was elevated. Then you have that movement of offshore to onshore, which is why we do see onshore stocks in Europe remaining to the higher side. So that's what we have for you today. If you have any questions, please let us know. You can find me on Twitter, find us in the comments section. And as always, we appreciate your support. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.